you are not as far away from profitable trading as you may think. There's a massive amount of information pulling you in all different directions, so your confusion is warranted and understood. But the truth is, there are only a few very specific skills that it takes to have a profitable trading career. And in this video, I want to be sharing with you 3 technical analysis secrets that I can guarantee will improve your trading and help you master the 3 skills it takes to become a professional trader. Welcome back. Just in case you're brand new, my name is Steven. I've been trading for about a decade, and on this channel, I try to share all the expertise and skills that I've acquired over the past decade of my own trading career to you to help speed up your journey to profitable trading. Now, let's go ahead and get started with secret number 1. Secret number 1 is that technical analysis by itself does not work. Don't get me wrong, there is a place for technical analysis in trading. Technical analysis is even necessary to become a profitable trader, but technical analysis by itself does not work. Now, I know what you're thinking. If that's the case, then why would I even learn it? I'm going to get into that in just a second. First, though, let me give you an analogy to help you understand what I mean. Technical analysis is like knowing how to play blackjack. You can know how to play blackjack really well. You can know every rule to the game. And yet, even though you know every rule to the game, you can walk into the casino and lose money at the blackjack table. Now, imagine you knew how to count cards. Counting cards is just a strategy that players use in order to create a mathematical edge over the casino. It's the strategy players use to have a statistic advantage that ends up making them money over time. If you just know technical analysis, that's like knowing the rules to blackjack. You can know the rules to the market, but you can still fail as a trader. And just like in blackjack, players create a strategy that gives them a mathematical statistic edge over the casino. In trading, we create a strategy using different technical factors that we repeat over and over, and that gives us an edge over the market, that gives us a money-making statistic advantage over time. But the next question is, if we need a strategy based around technical factors, then how do we create a strategy?
I have a very specific way that I create trading strategies. But before I show you that, I want you to keep in mind that all technical factors are not created equal. So just a little foreshadowing here. By the end of this video, you're going to know the 4 technical factors that I've seen work the best throughout my decade of trading experience. So make sure to stick around for secret number 2. Let's go ahead and talk about how I build strategies though. The first step for me building a strategy is to create what I call conditions. Conditions are going to be technical factors that align before you look for an entry reason. These could be things like market in trend, market at a moving average, market oversold, divergence on an RSI indicator. It could be things like the market just created a double bottom. All those would be conditions before I look for an entry reason. So every strategy that I've ever created, every strategy that I use starts with me analyzing the market and finding the conditions that meet the criteria of the strategy that I'm trading. And by the way, this is all part of an acronym I use to create strategies that I call CEST. CEST stands for conditions and E stands for entry reason. So after we have our conditions met, the next thing we're going to do is start looking for an actual reason to enter. The problem that most traders have is that even if they have a strategy, they don't know exactly when they're going to press the buy or sell button, depending on if they're going long or short. So because of that, they get confused even if they have a good set of conditions on when they're going to place the trade. So for that reason, you want an exact rule for when you're going to place the trade. Is it based on a candlestick pattern? Is it based on a few different candlestick patterns you use? Is it based on a chart pattern? Is it based on a limit order based on Fibonacci? What is your actual reason for entry? You must have a rule for that in a rules-based strategy in order to stay consistent to it. In CEST or CEST, left, the S stands for your stop loss. In every trading strategy I've ever used, I have a place where I know I'm wrong. And I'm gonna get out of the market if I know I'm wrong. So if the reason I initially entered the trade no longer looks to be valid, then I have my stop loss set in an appropriate place, which might be above or below structure, above or below a swing high or low, above or below a candlestick, in order to ensure that I get out when the market's showing me it's not aligning with the initial analysis that I did. You're going to lose trades at times. And when you do, you want to make sure you have a plan in place so you're not just guessing at when you're supposed to get out of the market. That can lead to losses that are much higher than you really want them to be, and eventually could possibly lead to you blowing your entire account. So stop loss is what the S stands for. And in CEST, it stands for conditions, entry, stop, and did you guess target? Target is the next one. We need a place where we get out if we find out that we're wrong in our analysis. But we also need at least an idea of where we're going to be getting out if we're correct. What if we're right? Where am I going to take profit? Is it going to be based on this level of resistance? Is it going to be based just on a specific reward to risk ratio? These are all things that you need to consider when creating a strategy. And what you just learned is the exact process that I use when creating a strategy. I create conditions, I create an entry reason, I create a rule for my stop loss and a rule for my target, and that together equals a rules-based strategy like counting cards in blackjack, which gives me an edge over the market over a long period of time.
Now, secret number 2. Here, I'm going to share with you my 4 favorite technical factors. Now, you just learned about CEST. What we're going to do is combine all 4 of these technical factors in order to create a strategy. Just like counting cards is a strategy for winning at blackjack, this strategy is going to be what gives us a money-making edge over the market. Now, just keep in mind that these are just the best technical factors from my experience. Depending on your trading style, you're more than welcome to have more than 4, to have completely different technical factors than me. But from my experience, these are the technical factors that work best. And they are, number 1, trend. Number 2, major levels of structure. Number 3, chart patterns. And number 4, candlestick patterns. Now what we're going to do is go look at these on a chart. We're actually going to build an entire strategy based around those 4 technical factors. And we're going to use CEST in order to do that.
All right, so let's build a strategy together using CEST and the 4 technical factors that I just told you were my favorites and the ones I've seen work best throughout my decade of trading experience. Number 1 on the list of technical factors for conditions for me is going to be trend. I'm going to look for trend when trading this specific strategy every single time. Now, a trend is normally very easy to spot, and if it's not easy to spot if something's in trend, then it's not in trend. So that's how you can tell. If it's getting difficult to figure out if something's in an uptrend, a downtrend, or consolidating, it's more than likely just consolidating. So for trend, we're looking for price to have made a lower low compared to the previous low. And as long as that has happened, as long as we have a close below this low, I consider a market in trend. I also like to use a moving average just to give me a better idea of that. The moving average of my choice is the 50 EMA. So for condition number 1, for me, I would want to see price below the 50 EMA and price creating a new lower low. So that would be condition number 1. I'm going to have multiple conditions for this specific strategy. I'll also end up with multiple entry reasons. You'll figure that out in just a second. But condition number 2 for me after trend is going to be a major level of structure. Now, I identify major levels of structure in a very specific way. The major level of structure for me needs to be the latest level that was broken in this downtrend, which is right here. And it must be a level that's been tested multiple times. So here we have 1 test of support, 1 test of support. That's already 2. But if I scroll left, you can see that price also reacted from this level as support multiple times, yet again, looking left. So this is what would qualify for me as a major structure level. I actually call these OTZs, or optimal trading zones. So condition 1, we need to see price in trend. What does that mean? We're below the 50 EMA and we've just made a new lower low compared to the most recent low. If that's the case, we have condition 1 met. Condition number 2, we need to pull back into what I consider a major level of structure, or OTZ. The rules for this is it's the latest level that was broken and it's been tested multiple times. Once I have those conditions met, I'm actually ready to start looking for an entry reason. Now, the two types of entry reasons that I personally use for strategies like this are, I like to use chart patterns or candlestick patterns. A candlestick pattern would be more of an aggressive move, depending on other market factors. If I want to be a little more aggressive, then I may just use a candlestick pattern. And a chart pattern would be a more conservative move where I don't want to be quite as aggressive on that specific trade. Now, on this trade specifically, we were looking at this as a candlestick pattern. If you look with me right here, you'll see that we get this engulfing candle. Price has since pushed lower. This is a live trade on a live account. You can see that right down here. And also, just so you know, this is a trade I sent out to every member of the TTC Forex University, which is our flagship course. They get email analysis like this 2 to 5 times per week. Not all of them win, obviously, but they do get these emails, including my entry stops and targets for these types of trades. If you're interested in learning more about that, click the top link in the description or go to www.ttcfxuniversity.com. If not, that's completely fine. Let's continue with the video. So, entry reason in this case was this engulfing candle. We have an engulfing candle directly after a doji candle, which told me selling pressure after all of my conditions were already met. So to break this strategy down completely, we had trend below 50 EMA, making new lower lows. We had major structure, previous level of support that was broken, tested multiple times. After that, we have our conditions met. So C is done. After C, what am I looking for? E, I'm looking for an entry. So these are my two choices for entry: candlestick patterns for more aggressive trades or chart patterns for a more conservative approach. In this case, we went with a candlestick pattern in this engulfing bar we just pointed out. Now, am I done creating a strategy? No. Hopefully you caught that. We still need to discuss stops and targets. So let's do that now. For stops on this specific trade and with this specific strategy, I like to do about 1 times the ATR indicator, and that might sound complicated. It's just an indicator that you can find on TradingView that gives you the average of the last 14 candles, the average size of them, so you can kind of stay in line with the volatility of the market when you're placing a stop loss, which is exactly what I did here. So I normally go 1 times this little indicator, which right now, if you look at my top left, it's 26 pips. So I went 26 pips above the high of this engulfing candle, which was the swing high of the pullback. That was my stop loss. So now I have C, E, S, and I need T. For a target, I've already taken off the first part of my position, but I wanted to hold the second part of my position until we got to the next major structure level. Again, that's a technical factor I use all the time for taking targets, for setting stop losses, for placing entries, is levels of structure that have been tested multiple times. So that's where my second target is, and that's going to give me, if it gets hit, around a 1.8 to 1 on the second part of the position. Let's recap really quickly everything. We have C, conditions, trend, and at a major level of structure as I've defined it. We have E for an entry reason, which is going to be either chart patterns for a conservative approach or candlestick patterns for a more aggressive approach. Then we have S, which stands for our stop loss. And for me, that's going to be 1 ATR above the entry candle. Then we have T, which stands for targets, which is going to be at the next major level of structure price is going to hit if it goes in my direction. So this is my version of counting cards against the market. Pretty solid stuff, right? Go ahead and click that like button for me if you enjoyed the video so far. And now let me actually take you down to the 15-minute chart, because in this case, I can give you a bonus technical factor that I love to use. So let's do this again on the 15-minute chart. But on this chart, we're looking at this as more of a reversal. We did actually get a double top here. So again, chart patterns, here's my double top. And what I want to show you on this chart though is a bonus technical factor. And that bonus technical factor is RSI divergence. Whenever I see RSI divergence, it is another technical factor that I will consider using for an extra condition with a strategy. And it was one of the reasons we did a more aggressive approach on this specific trade. If we look here, we have the highs of price consistently heading in which direction? Up or down? They're going higher, right? Well, if we look at the RSI indicator, what are the highs of the RSI indicator doing? They're consistently getting lower. This is what we call divergence, and it can be another hint of a reversal. It can stand, at least for me, as a bonus condition. So keep all that in mind, and let's move on now to the last technical analysis secret.
Secret number 3 is that technical analysis will never fix your mindset. No matter how good you get at technical analysis, no matter how good you are at analyzing a chart, knowing technical analysis will never fix that space that's right above your eyes, where hopefully your brain is. Right between your ears, the mindset you have when you're trading, your discipline, your ability to stay disciplined to a strategy, stay disciplined to a risk management plan, your ability to keep from switching strategies, to keep from moving your stops and targets, Your mindset around trading will never be fixed with technical analysis. But here's what will fix it.
Good trading psychology and a good trading mindset is not something you're just born with. It's not something that comes natural, but it's something that you can learn. And if you want to be a profitable trader, it's something you must learn. Every single profitable trader, including myself, at some point was losing money due to having bad trading psychology. And eventually, they made the realization that trading psychology is just as or more important than the strategy that you trade. They flipped the switch, got better at trading psychology, improved their trading mindset, and then became profitable traders. That's the journey nearly every profitable trader goes on, and it's the journey that you're on right now. Let me give you a short story. It won't take long. When I first started trading, my trading psychology was absolute shit. It was so bad that I was consistently switching strategies from one to the other on almost a daily or at best weekly basis. I never stuck to any of the rules I had in place, including where my stop loss was supposed to go. If I started losing a trade, I would just keep moving my stop loss down because I was terrified of actually losing money because I had a bad trading mindset. I also would move my target up if I thought the market would keep going. But what does that even mean? I thought the market would keep going? That's called trading based on emotions, and that's not what you do if you want to be a profitable trader. And I also caught myself consistently trading not based on the strategy or the plan that I had in place, but trading based off solely fear and greed. If I was really greedy that day, I would try to buy 7, 8, 9 times throughout the day with no entry reason. If I was really scared that day, I would just skip trades that actually met all the rules of my plan. So trading based on emotions is what caused so many losses for me, what caused me to blow my first account, nearly blow the second one. And all of those mistakes are what I hope to help you avoid with these 3 hacks. So with that being the case, let's go ahead and get started with hack number 1. So the first trading psychology tip that literally saved my trading account was that I needed to manage my expectations. And at the time, I didn't understand what trading was. When I first started trading, I saw trading as a way to get rich overnight, like many of you probably did at first as well. And eventually reality sets in and you realize, oh shit, this is a lot harder than the guru or whoever said it was going to be. This is a lot harder even than I expected it to be. And instead of making money and getting rich like I thought I was going to, I'm just consistently watching my savings account dwindle as I add money to a trading account and lose it time and time again. That's the realization I had. And what that did for me is help me to realize that trading isn't some kind of get rich quick scheme. Trading's a way to build wealth over time, and it can help you become wealthy. It can, but not as fast as most people think it can. So understanding what trading is, which is a way to get wealthy over a long period of time, not a way to get rich super fast, and managing your expectations by saying, okay, it is really, really, really unlikely and nearly impossible for me to be making 100% a week. 100% a month would be wildly nearly impossible. 100% a year, now we're getting closer to something that's doable. And it all really depends on a ton of different factors like the time frame you're trading, the strategy you're using. There could be situations where you make more than 100% a year. There could be a lot of situations where you make less, but managing your expectations and getting away from expecting to get rich within 12 months just from trading, that is a very unlikely scenario. So I wanted to step in real quick to talk a little more about trading expectations. As I said, it's impossible for me to know what you should expect out of your trading because it's based on an infinite number of factors. There's literally no way for me to know or to tell you what you should expect. The reason I said 100% a year is doable is because that's what I've come to expect based on my own experience. As you can see on the screen, this is MyFXBook, a third-party verifier that verifies track records and verifies your trading results. This is my account, my real Owanda account, and this is my results over the past about 8 months of 2023. As you can see, we have about a 61% return, and if we do the math on that, 61% divided by, it's not quite 8 months, but we'll go 8 months, is 7.6% per month. If I multiply that by 12, and if everything continues as planned, I'll make about 91% this year. So that's why I'm telling you that at least based on my experience, my expectations have come out to around 100% a year in my own trading. So in conclusion, to help out with your trading mindset, remember that trading is a long game. Learning how to trade is going to take a long time, and then becoming becoming consistently profitable with a large account is when you're going to make money. Becoming consistently profitable with a small account, you will make money, but it's going to be a smaller amount of money. And that's okay. That's supposed to happen. That's exactly what I went through. And eventually I was able to build that small account into a multiple six-figure account that I trade now. So don't be frustrated hearing that. Just understand that that's the reality of trading. Tip number 2 that drastically improved my trading psychology was backtesting my trading strategy in order to increase belief. If you're trading a system or a strategy, or God forbid, you're just trading without a system and placing buy and sell orders based on emotions like I did at the beginning of my career, you definitely got to stop doing that. But if you're trading just based on strategy you've never tested, you're just believing what somebody else said that taught it to you, or you're just placing trades based on what you think may work, and you've never tested it in historic data, you're gonna have a really hard time sticking to that strategy. It's gonna be nearly impossible for you to go through any type of losing streak without trying to switch to another strategy and getting shiny object syndrome, where you're consistently just looking for the next best thing. What you must do in order to improve and increase belief is you must back test that strategy to see that it's at least worked in the past. That's going to increase your belief, which in turn will increase your discipline and help you with your mindset, help you with your trading psychology. The more you believe in this strategy, the easier it's going to be for you to handle losses and for you to handle inevitable drawdowns. When we're trading, back to number 1, understanding what trading is, we're trading not based on the fact that we know what the market's going to do. We're trading based on a statistic advantage that we have over a long period of time by trading a strategy that we've made or learned that's proven to give an edge through the backtesting process. And backtesting itself is really simple. Let's say you wanted to trade, and this is not a strategy I would suggest, but let's just say you wanted to trade hammer and shooting star candles that come off of a moving average. If that was the case, you would just take that exact rule set, go back through historic data, and look for every time that happened. Every time a hammer candlestick came off a moving average, did I win or lose that trade based on my stops and target? Every time a shooting star candle came off a moving average and we were already in a downtrend and that happened, did I win or lose that trade? And what was my reward to risk ratio? You would go back and you would record all of that information back in the past for at least 100 instances of that happening. And once you have done that, then you will see whether or not that strategy has made money in the past, and therefore whether or not it's likely to make money in the future. And again, this is something that literally saved my trading account because it helped me to increase my belief in the strategies I was trading to the point that I now have mastered my mindset in terms of trading and hardly ever make any trading mistakes. I definitely never switch strategies, move my stop, or move my target because of emotions anymore. And a lot of that was because I managed my expectations in terms of trading. I understand what trading is, and I've back tested all the strategies that I currently trade, and I've seen them work in the past. I've seen them go in and out of drawdown, in and out of losing streaks, and still come out on top after a large sample size, which again does incredible things for your trading psychology. And the last trading psychology tip that again completely saved my trading account was understanding and managing risk correctly. So just understanding the risks involved in trading is the first part of that. You need to know that you're going to have losses no matter how good you get at trading. You could understand technical analysis like the back of your hand. You could understand the strategy you're trading like the back of your hand, and you will still have losing trades. You will still go through drawdowns. I've been trading for a decade. I still have drawdowns. I have weeks that I don't make money. I have weeks that I lose money. That's a very normal part of trading, and the way we help to manage our emotions while we're going through those losing streaks and sometimes those losing weeks is we manage our risk correctly. If I go through a drawdown of, let's say, 5 trades in a row and I'm risking 10% of my account, that's a 50% drawdown in my account. If you had a $100,000 account, that would be a $50,000 drawdown. That's not something anybody would be comfortable with. That would be extremely difficult to manage your emotions during a drawdown like that after only 5 trades. So instead of risking 10% per trade, it's way better to manage risk correctly. Let me explain why people risk that much though. When you're first starting out, again, same thing that I did, you're looking to make money as fast as possible. You want to literally get rich overnight, or at least as fast as you possibly can. And because of that, the way risk works is the more you risk on a trade, the more you stand to make on a trade. But vice versa, the other side of that coin, the more you risk on a trade, obviously, the more you could possibly lose as well. So although when we first come into the market, it's really enticing to think about what could happen if we won 10 trades in a row with a 10% risk. We could get rich, but winning 10 trades in a row without even knowing how to trade is a very unlikely situation. And the much more likely thing that will happen is you'll lose 5 to 7 trades and you'll be in a massive drawdown. You'll lose a majority majority of your account because you're risking 10% per trade or more. Now, the correct way to do this is to figure out a number that you would be comfortable with, because there's no cookie cutter answer. I can't tell you exactly what to risk. I have no idea what your risk tolerance is, and I don't know how much you're willing to lose on a specific trade or during a drawdown. You have to decide that number. But once you have that number decided, you can start to determine what you need to risk every time you place a trade. For me, I risk between 1 and 2% of my account value. Let's take that same scenario now. I lose 5 trades in a row. Well, if I lose 5 trades in a row, which I have before, even now after a decade of trading, I've lost 5 trades in a row recently. When I lose 5 trades in a row, I only lose about 10% of my overall account value. So that hit is not nearly as hard as it would be if I was risking way more than that. So my emotions still stay under control, and it keeps me stable. It keeps me from wanting to switch strategies, from wanting to change the strategies that I'm already trading, from getting super frustrated and quitting trading for a week. It keeps me from making emotional mistakes because I don't have all of my hard-earned money at risk during one trade. So again, to recap, manage your expectations and understand what trading truly is. You're not going to be making 1,000% a week. Telling you what to expect is really difficult because, again, it depends on the strategy you're trading, on your trading style. It depends on the time frame you're trading. It depends on way too many factors. But don't be expecting 1,000% a week. Trading is not something where you know exactly what the market's going to do, and that's why you're a profitable trader. Trading is having a statistic advantage that plays out over time. You'll go through wins and losses, but if you have a profitable strategy, then the wins will prevail and you will have profits in your account over a long period of time. Number 2, backtest your trading strategy. Take the rules you've created or learned for a trading strategy and look at them through historic data for at least 100 trades. No matter how long it takes to find that 100 trades, you want to do that so you can prove to yourself that it's a strategy worth trading. So you can increase your belief and therefore increase your trading psychology and increase your trading mindset. I said increase, I meant improve your trading psychology and your trading mindset. So backtesting is number 2. Number 3, probably one of the most important on this list, is to understand the risks involved in trading and manage those risks accordingly by applying a risk management plan that keeps you comfortable even during losing trades, that keeps you comfortable even during periods of drawdown, which are inevitable and will happen. If you do those 3 things, I guarantee your trading psychology will improve dramatically. Now, if you are someone who is brand new or struggling to learn how to trade and you want to know the exact steps that took me from a construction worker roofing houses to a professional trader, then I'm looking for 500 new or struggling traders right now to join us in the TTC Forex University. It's a full mentorship program that includes a university style course taking you through all the steps that I personally took to go from construction worker to professional trader. It also comes with the Pro Trader Report and email analysis, which are trades I'm taking throughout the week that give you a glimpse into how I'm actually trading in real markets and in real time. On top of that, you get priority coaching support through email, meaning any questions that you have. It'll be me on the other end answering those questions for you to ensure you have the smoothest journey to profitable trading possible. And on top of all that, it also comes with a 30-day money-back guarantee, so you have peace of mind that if you get in the program and for some reason decide you don't want to trade Forex anymore, no big deal at all. Just send us an email and we'll get you refunded ASAP with no questions asked. If that's something you're interested in, go ahead and go to www.ttcfxuniversity.com. That'll also be on the screen. If not, that's completely fine too. I hope you enjoyed this video and I'll see you in the next one.